and welcome to another episode of Fintech Focus TV with me, Toby Babb. Today it's another of our debate series, and I'm delighted to bring to you James Maxfield of Ascendant Strategy and Alex Knight of Baton Systems. Chaps, how are you?
Very good, thank you. How are you?
Very good indeed. Thanks. Very good indeed.
Very good. Thanks, Toby.
Great to have you both on and talking about a subject which I think is one of the most prevalent in the marketplace at the moment. There's been an awful lot spoken around blockchain and various waves of progress around it, particularly in capital markets and hype cycles that we've been looking at. You guys over at Ascendant Strategy put insight papers and roundtables on this back in 2019, and there's going to be more stuff that's coming up over the course of this year as well. So I want to look backwards and as well as forwards. But before we do that, James, let's start with you. Can you give us a bit of background about yourself and Ascendant Strategy, please?
Yeah, thanks, Toby. My name's James Maxfield. I'm a founding partner of Ascendant Strategy. We are a boutique post-trade consultancy that really focuses on helping capital markets institutions solve a lot of the complexity that sits across their middle and back office.
Fantastic. And highly relevant place for advice and consultancy needed at the moment. It seems to be one of the kickoff areas again. I think we last spoke on Fintech Focus back in probably 2019, wasn't it? I believe, and we were talking about what was happening in the business at that sort of stage. It seems post-trade's only getting more relevant, doesn't it?
Absolutely, yeah. And I think a lot of the challenges associated with kind of legacy technology and the processes that support them are still there in the most part for most organisations, which makes kind of this topic as a discussion clearly kind of very relevant.
And talking about highly relevant companies and exciting spaces to be working in, Alex Knight, Baton Systems, give us a little bit about yourself and the company.
Sure, thank you, Toby. So Alex Knight, I spent 19 years working at one of the large American banks in FX sales and trading and then in FX prime brokerage. Joined Baton back in October of 19. Baton is for those of you who don't know it, it's a financial technology firm working with some of the largest banks in the world to reform how payments are made in financial markets. We have a distributed ledger platform that allows for real-time visibility and movement of currencies and securities. And we aim to sort of reduce settlement risk and increase liquidity.
I think it's been a business that I've got to know a lot over the last year or so. And the reputation and everything that's working with the company seems to be a story of massive success through a very difficult time. So looking forward to hearing a little bit more about that and all of your insight later on as well. So James, let's shoot back to you. This 2019 paper that you put together in the webinar series was really looking at the progress of blockchain in capital markets. I think I hosted a debate probably around 2018 where it was talking about sort of 5 years and 10 years adoption of blockchain in capital markets at that sort of stage. Suddenly it seemed to rapidly progress, and we thought blockchain was going to be the next big thing, emperor's new clothes for a short while, and it sort of retreated a little bit, and now it seems to be coming back to the fore again, particularly with everything that's happening in the wider world of the crypto space. Those two are very separate, however, and I know you've got some thoughts on that. Give us a précis of where we were in 2019 and some of the highlights and insights that you're able to bring from that.
Sure, thanks, Toby. I think if we maybe go back even prior to then, I think as the emergence of blockchain and distributed ledger technology started to gain traction, probably almost, I would say, 10 years ago now, there was a lot of excitement from the industry around how bringing people together on a shared platform that would give almost a single version of the truth was really going to be an enabler for investment banks to get rid of a big chunk of the cost associated with processing what has historically always been two very separate records of data. So as an example, Toby, you may be in one bank and you may have a view of trades and transactions that you're facing myself with. I will have my own view of that data. And whilst they should be able to tie up and kind of match each other, the reality is that there's so many complex moving parts around data and attributes within each of those trades that you quite often end up with a lot of exceptions. And it's those exceptions that really became a catalyst for a lot of the discussions in the industry as people and consortia started to get together and think, can we use this technology as a way of being able to take out all of that cost? And I think just to throw a few numbers out there, I think it was probably 2017, I think Accenture wrote a paper on the future of capital markets. And in there, they talked about the cost of the industry, but they calculated there's around about $130 billion worth of cost just associated with a lot of this post-trade reconciliation and settlement between bilateral parties. So it's not surprising that the industry got quite energized around, could a technology platform that removes a big chunk of that cost be able to solve a lot of industry troubles? And not only does that make the process more streamlined, but let's not forget that even 5 or 10% of that $130 billion worth of costs is quite material for the whole capital markets industry. So I would say that there was kind of that as a backdrop. And again, I think a lot of those early use cases, when I think of the, maybe the R3 consortium and some of the other consortia that were bringing banks together, they were very focused on being able to try and see how can they apply that technology to solve those problems. I think when we looked at this 2 years ago, what we found was actually probably a couple of kind of key themes. I think the first one is, irrespective of the technology, I would say multi-bank collaboration is actually extremely difficult to do for a wide variety of reasons. And if we look at the failure of some of the industry utility conversations of 5 or 10 years ago, that was probably a good reference point to, whilst the world may want to come together on common platforms, the reality of the technology and processing environments that banks operate and live in makes actually that very difficult to bring together. So I think there was a general feeling that actually, whilst it would be nice to bring organizations together and solve it as an industry, the reality is that's quite different. And then I think the second point was, what we found was a lot of confusion around blockchain generally. Some people would talk about Bitcoin and crypto assets, when the reality was what's relevant to the post-trade environment is none of that. Actually, cryptocurrency is almost irrelevant to the discussion. But actually what is highly relevant is the ability that distributed ledger technology has to be able to bring together industry participants and almost create this single record or this single version of the truth. And I think that where we left that discussion was multi-bank blue sky consortia is very difficult. It's not to say it won't happen, but it's hard, long tenured, and ultimately very expensive for a technology provider to try and facilitate, particularly because it takes a long time. But what we could see is an emergence of what we would see pragmatic use cases where perhaps smaller groups of the industry were getting together, trying to perhaps collaborate and solve some of these post-trade processing problems on some of the solutions that kind of DLT was just starting to be used and leveraged for. And I think that was certainly where we left the discussion, I would say kind of 2 years ago. What's interesting as we revisit that now is starting to explore, what's been the progress of the big industry consortia. And again, that continues to be kind of quite slow. But what is interesting is the emergence of organizations like Alex's, where some of these smaller, quite targeted use cases are now starting to get traction around being able to solve the problem that I alluded to earlier, around multi-participants trying to reconcile and agree different data sets.
Yeah, absolutely. I think that's fascinating, and it's absolutely in line with what we've been seeing, and where, despite the fact, I think one of the interesting things about this last year, and all the events of 2020 is it's allowed and probably pushed a little bit more collaboration and people to be, to sort of drop those guards a little bit and create opportunities within that. And there's a huge amount of nimble businesses, agile businesses, who've been able to innovate and provide some of those solutions to some of those issues. And if we look, at some of the things you've been mentioning there, cost reduction, or a lack of friction, and all those sort of opportunities, it's those opportunities that really drive some of the pressures that are coming externally because of everything that we've been seeing that's allowed that to happen. Alex, tell us a little bit of your view of what you've just heard, and cast our minds back to 2019 as we speak then, and we'll then move into the current age, which seems to.
Yeah. So look, I think a lot of what James said, I agree with wholeheartedly. In fact, most of it. I think the challenges of bringing in a standard process, but reversing in a blockchain related progress into existing business processes is really tough. Different firms have different methodologies that they use. The blockchain process sort of requires that you have a standardized process, and you have sort of standardized events within that chain to notify the participants of what status you're at. That's really tough. I think that the coin world, has been a challenge, as James said. Let's not confuse perhaps things like Bitcoin with maybe some of the stable coins that are now being that are now being approved in some way or other, and the CBDC that people are working on. Those are important pieces of progress. And let's think about, what do they bring? They bring not only that sort of post-trade reconciliation simplification and the operational simplification, they also bring, I think, an enhancement to the actual payment process. The exchange of asset between two counterparties, which historically has been, I think, a little bit of a challenge, partly because of the lack of visibility of data, partly because people are working with massive data sets that are not normalized. James mentioned this issue around, the ongoing reconciliation. You then have the repair process that happens sort of post-settlement as well. Lots of manual processes and siloed systems and so on and so forth. That's a massive challenge. And again, to reverse blockchain into those is really tough. Really a difficult thing to achieve. Our view is that when you have, almost all assets are digitized already. Yeah, so there's the ability to work with better data sets and to bring them together better. And I think that's what we're seeing people start to look at better. In terms of the collaboration piece, I agree. I mean, one of the challenges we have is there are lots of different blockchain standards that are out there that people are looking at, lots of different coin types, and some people are trying to pull them together. But there's still a challenge, I think, of interoperability, which sort of presents itself and becomes, really quite difficult to solve. I suppose in one space that we're looking at closely, and we sort of have a really close, sort of sense of, is around FX settlements. We are seeing now through a variety of different, different sort of organizations, we're seeing increased focus, I think, on settlement risk and PVP, and how that can be achieved outside of the CLS eligible transactions, which of course already achieve PVP.
Yeah.
And that maybe is an example of where we have a group of interested industry participants that perhaps will feel the urge to work together in a sort of proactive, productive, leadership style way to try to find a solution, without necessarily gaining a competitive edge over one another, but working collaboratively to solve a problem that frankly needs to be solved for the industry as a whole.
Yeah, and I think that's been the big sort of switch. If you look at, I go back to probably the early 2010s, where everything was about advantage over the competition. The race to zero latency effectively being the sort of prime example of that to me in capital markets. And I think actually this is very much pointing towards the need for a solution that can't be solved by one organization holding all the aces. And that creates a sort of very interesting dynamic in capital markets where that hasn't been the DNA or the culture or the way of doing business for many, many years. So James, when we're faced with that sort of background to everything, and we look forward now as to having done that report and now starting to look at this again in 2021, we have a very, very different landscape that we're looking at in all sorts of aspects. Tell me a little bit about how things have progressed over the last 24 months or so, and what your crystal ball looks like for how this moves further forward now.
So I'm not quite certain it's a crystal ball, Toby, but I think I would certainly
you haven't been too bad on the prediction so far, have you?
Yeah,
you weren't a million miles off. If you can look back in hindsight to 2019, you weren't a million miles away from everything.
I mean, I think I probably build on Alex's points. I think where the industry is moving towards now is there's probably a couple of things. I think there is recognition that the cost problem that has characterized capital markets, custodians, investment banks, asset managers, and the role that post-trade has to play in that has not gone away. So no one has solved this. And I think whilst organizations continue to look for solutions, no one has really found it. I think there was a lot of excitement last year around performance of the industry. Clearly, we saw record numbers around trading and profitability for organizations. But again, I think that's noted. It's really a one-off blip. There's not going to be a sustainable change in economic fortunes for people. So that cost challenge is still there and hasn't gone away over the last couple of years. And I think that now, to the point around collaboration, I think it's been long understood that there's very little differentiation in post-trade. If I have a more efficient process than Alex, that doesn't necessarily make a massive difference to my bottom line. It's interesting. What's more interesting is if Alex and I can both have a more efficient process, that reduces my cost and his, then actually that's a good thing. So let's not compete on post-trade costs. Let's compete on trying to get the cost down. And actually the other competitive factors around capital markets, will kind of leave those to themselves. So again, I think that kind of, I would say, maturity of discussion, I think, is starting to evolve as organizations realize they need a solution, and the things they've tried over the last decade have really not been able to move the needle. And you could probably say they've done all the obvious stuff. You know, they've fired people, they've moved processes to different locations. So actually there was a need for something else. So I'd probably come back to some of the things that Alex and some of his, I would say, competitors in the industry are doing, is starting to look at these more simple use cases within post-trade. And what I mean by that is, if I think about a payment, I've got to move a currency from A to B, very simplistically speaking. If I'm thinking about securities, I then need to have a security leg to the trade and a payment leg to the trade. I could be crossing different jurisdictions and different markets, and that's obviously a much tougher nut to crack. So I think the first point is being able to be quite deliberate and focused around understanding the complexity of the process you're trying to play in. I think that's probably one theme. And then I think the other interesting area is being able to help organizations join up the value associated with adopting this type of change. And again, I think we're starting to see solution providers realize that they can't just go and show a solution to an organization and say, you should use me because I do all this good stuff. They're really having to help the organization join up the dots internally, actually, for themselves. So again, I use a Baton example, something I know Alex holds quite close to his heart from his prior days in a bank. But if I can start to link the economic benefit of just better payment processing and faster and quicker payment processing to the amount of capital that I need to hold against that settlement process, if I can join those two conversations together, then actually my benefit case and my impact to the organization can actually be quite significant. And I would definitely see that's a theme that we're seeing, this kind of reality that post-trading in isolation is interesting. But if you can start to join some of the economic factors that are also interesting to an organization, and capital is a really interesting one, then I think that makes the value a lot more compelling. And I think to your final point around the crystal ball, you know, the realization now that distributed ledger technology can provide a lot of value around automation and just being good tech, which I think probably wasn't there 2 years ago. It's a good technology platform, and then taking that technology platform to solving real world business problems that take out cost and reduce capital. That's clearly where we see a lot of these interesting stories coming from, and where we see progress being made.
Yeah, that's fascinating, isn't it? Because legacy technology has been the sort of Achilles heel of the industry for so many years, about how expensive it is and how risky it is to remove some of the incumbent enterprise solutions that have just been there for so many years within that tech space. And when you look at something like blockchain and the sort of lack of I guess incentive for an enterprise solution to really embrace that technology, which disrupts their model, it's been really difficult to push that further forward. So when you talk about solution providers like Baton, as we've been talking through there, and targeting specific opportunities within the efficiency mode of taking that further forward, that surely pushes us towards being able to eat the elephant chunk by chunk, so to speak, in terms of the bigger issue. Alex, tell us a little bit about how you're seeing that sort of issue, and how you're positioning yourself to help.
Sure, and I can sort of reflect on many of the conversations that we have with, I'm sure, many of the same people that James talks to. One thing, I think, big rip and replace projects, there's not a huge amount of appetite for those. People are nervous about risk. They're nervous about really long time horizons, and that's a big challenge. So overlaying existing processes, pulling together existing processes, providing a stronger solution that maybe sits on top of existing processes before you start to pull them out piece by piece, I think is a much more palatable process for many people. People want to see a return reasonably quickly. They don't want to wait and have a massive big bang project that's got a 3-year time horizon and they see no return until 3 years is up, and then they're at risk, the whole time that nothing happens there. So I think that's one thing I'd sort of reflect on. I think the point that James made, you got to join the dots. You're exactly right. In the conversations that I have, I think it's very difficult to get something across the line if all you're doing in inverted commas is reducing headcount by 5 people. or allowing, particularly if it's 5 people in a low cost center, sort of who cares? That's not enough to sort of justify something. So you can talk about increasing capacity. Okay, that's good. That helps, but in a way that's just the sort of inverse of reducing headcount, isn't it? Where we have found that the conversations become much more sticky and much more compelling is when you do start to bring in those other functions that will benefit from the sorts of solutions we're talking about. So the sorts of solutions that, for example, will deliver, payment versus payment, or that will allow you to move assets really quickly, will allow you to manage your liquidity better. And so you start bringing in people who are concerned about risk, people who are concerned about capital, people who are concerned about liquidity and funding. Right now, as everybody knows, there are some real liquidity and funding issues out there in the market. There are regulations that need to be observed, but there are some currencies that are incredibly expensive to fund. And when banks are looking around at sort of what they need to keep an eye on, allowing their liquidity and funding costs to get out of control is a perfect thing to look at. So I think you need to start bringing those conversations and those stakeholders together to start to create something that's sufficiently compelling for a big organization to say, hold on, this seems to make sense. And I've even had people, ops people at major banks reflect when I've spoken to them, and maybe it's the 3rd or 4th time they've had an engagement, a conversational engagement with Baton, and they've sort of said something along the lines of this: what, last time we looked at this, we only thought of it through the lens of operations. Yeah. Now what we're doing, and because they're doing it or we're doing it, something's clicking, and they're getting other people involved in those conversations, saying now that the bell is starting to ring, and it's starting to make a lot more sense. And that's quite an interesting thing for us to observe, I think, is as you bring in these stakeholders, and frankly, as a technology provider, as you start to understand your own value proposition better, and where you can bring value and pull in those stakeholders, that's, I think, where you have the greatest chance of success.
Yeah, I think this is interesting for me, because you talked there about some of the motivators to make big banks pay attention, and I'm fascinated with this, because I talk all day, every day to companies who've got the great ideas and great solutions and great technology solutions that are there to help large institutions in numerous different ways. Now, quite often the difference between success and failure in those businesses is, the actual solving a problem that needs to be solved. So great technology, great pitch, great belief in what that product's supposed to be doing, but actually doesn't move the needle enough for them to pay attention. Right here, I think what we're talking about with DLT is an opportunity to really shift the needle for these organisations, and people recognise that, but they also have that sort of caution about what's needed to do it, and of course the difficulty of implementing everything in there, which is where some of the hype circles go, in terms of, this sounds like a great thing, but actually what we're talking about here is something that's really expensive, really complicated, and maybe we'll just tuck it back until it develops a little bit further, which means it's day will be coming. And as I said, 2 years ago, people were saying 5 to 10 years until it's mainstream within where it goes. It looked like that was accelerating to probably 2 years. It probably is somewhere in between at the moment in terms of where we're looking at it. But a lot of it is about people recognizing as a buyer in a bank, and I speak to people in those positions, it needs to be compelling enough to be able to make that happen with as little friction and pain in terms of putting that in together. So James, actually, I'm going to switch to you on this, because I know this is something which you believe in strongly. That the role of solutions providers as catalysts of change is something we've spoken about in the past. Their ability to bring communities together and to solve these problems in a iterative manner would seem to be the solution to that. Is that something you're seeing and believe in?
Yeah, I think so. And I think kind of part of the reference point is, having spent a long time within sell-side institutions in senior management roles, your day job is really busy and really hard and emotional and stressful. So your think space and ability to go and work with your, let's just call them your corporate partners in different parts of the organization, who could be in different regions, you've got a really small amount of time to do that, actually. And again, I think, sometimes fintechs approach banks and they kind of get quite frustrated by what they see as disinterest, or even sometimes they say, these guys are dinosaurs, they're not innovative. and they're kind of missing the reality of the day job that a lot of these people live and breathe. So, you know, I view this very much of the successful solution providers, A, can understand that, so they recognize the environment they're in, and B, can help position their product against that sort of backdrop. Now sometimes that may well need a solution provider to actually go and do some of their homework in an organization, maybe go and talk to some of those different stakeholders bilaterally, and then maybe bring a conversation together at an organization. You know, we've done this before, and this is something that we do sometimes. We quite often go in and help that for free up front, actually. That will be to help somebody organize their thinking, position what they're trying to achieve, and enable them to have that conversation with the relevant different stakeholders in the organization. And I think if you can do that bit, your chances of success and delivery of a solution into a large, complex organization kind of multiply by the nth degree. But I think that's kind of that, there's a tipping point there. And again, you know, if you talk to a COO, or you talk to a CTO, or you talk to a corporate head in the bank, you know, they're very open to innovation. You know, they hate the clunky post-trade process typically that they operate. It's too expensive, don't understand it, overly complex, needs loads of people, and quite often has lots of problems which you should be able to solve by automation. So I think there's a market there to be sold into, but I think the real key piece, certainly from our perspective, is being able to help the organization join adults and realize that part of your role is actually to probably help them with that stakeholder journey and to get people on board. And then I think I'm going to echo Alex's point, then be able to bring something that can give value quite quickly, or something which is kind of quite obvious.
Yeah.
If you're pitching a 4 to 5 year transformation program where you're asking an organization to take a big leap of faith around investment and risk profile, that's a really, really tough sell. And it's probably not unsurprising that those type of initiatives kind of struggle. So I would certainly see that kind of joining the dots and then being able to make the value obvious as really kind of key differentiators for any solution provider within capital markets.
Yeah. If I can just step in there, Toby, I think
I was going to suggest it.
Yeah, we've seen. I've spoken to James about this actually, but we've seen a really interesting use case, I guess, that maybe I can just sort of describe in summary. So, you know, a bit of background. You know, we have this shared permissioned ledger, distributed ledger, and we have a shared permissioned workflow that allows for the collaborative settlement on a PVP basis in the FX space. And it allows people, I guess, to control risk, but also allows them to settle when they want to settle, and to settle really, really quickly. So that sort of liquidity and funding piece is really beneficial as well. We talk to a lot of banks, and a lot of banks at a headline level are very enthusiastic about it. They see the need for it. And, you know, there's good work going around, and it's, you know, we can leverage off some of the successes that we've already had, and that's really encouraging. We had one particular bank that we were talking to, that we still are talking to, and we're now in a sort of process of implementation, where they decided that they would consume, or they would consume 1 month's worth of their FX data into the Baton platform, and they were able to model what their settlement cycles would look like using the Baton methodology for a subset of currency pairs and a subset of counterparties. You know, making obviously some fairly broad assumptions. And they were able then to compare what the impact was on their liquidity and funding, on their balances, on their capital usage, what the impact would have been of using the Baton methodology, using those assumptions, versus their existing methodology. Where, you know, they would have a mixture, I guess, of some CLS settlements and some bilateral normal in inverted commas settlements. Yeah. Mm-hmm. And the results we're told, I've not seen the results myself, were absolutely compelling. But what this took was somebody within that organization who had the bandwidth, who had the knowledge and understanding, who had the time, or was able to make the time. And this comes back to James's point about people are busy, yeah, but had the time to be able to run that data and understand it and interpret it, and then present it to his seniors, to present a really, really compelling, unambiguous use case. Yeah. And this for me has been so fascinating. We've actually sort of launched a program around a sort of like a 90-day methodology where we we encourage our customers to do exactly what I've just described, to consume their data into a demo platform, see what the output looks like, allows them to muck around with a couple of configurations. And then rather than it being a narrative, there are some real values that they can hang on to and present up to senior management to justify or not going ahead with the project. And I think that to me has been quite a turning point, because until there, a lot of the conversations we have, as I said, have been sort of narrative based, which is fine. Maybe that's sufficiently compelling, but in some cases, just a narrative is not sufficiently compelling.
I think it's many times that narrative isn't compelling. James, you were about to step in there as well.
Yeah, and I it was interesting listening to Alex, because it reminded me of possibly the easiest investment committee I ever went to in a prior role in a bank, where I went alongside the CFO for the markets business and the treasurer, and we wanted to ask for some spend to effectively improve some of the payment processing to enable effectively what was a capital reduction on the buffer. And for a really trivial investment versus the potential return on investment it was going to get, it was the easiest conversation ever, to the point that the CEO just said, I don't really understand the economics here, that they just look too obvious. And they were. And actually, 12 months later, this project returned double-digit millions of dollars in effectively funding benefit. And the single biggest reason for that was actually you had kind of these different stakeholders in an organization all lined up around a common goal. The solution actually was really easy. I've delivered some much harder, complex transformations in my time that didn't actually deliver anything near the type of return on investment. But I think it just kind of plays the point that when you can align the dots and where you can join those stories up internally in an organization, the impact can be quite compelling. But again, quite often it's an organizational challenge rather than it is necessarily either a technology or an execution challenge.
And that becomes really interesting, doesn't it? Because we've spoken a lot about collaboration being external, within this, but the internal piece is just as difficult in some of these institutions, right? Because I go back to another event I hosted maybe 5 years ago, and speaking on it was Rob Caseborn, who at the time was heading electronic trading at Deutsche Bank. And Rob was there with very open to speaking to a whole bunch. I think there's probably about 150 people in the room, taking questions and talking about the frustrations that many of these sort of smaller vendors were having about being able to add value to the major institutions. And Rob was very candid in the fact, saying, look, you need to have multiple stakeholders who are all batting your sides for this. And it's exactly what the pair of you have just intimated in terms of this being an internal challenge to say, look, here is, rather than a sort of single decision. And Alex, I can clearly see now why you've got the thinker behind your shoulder there, up on the wall as to where it goes. That dedicated time of actually being, encouraging people in those institutions to spend the time to make decisions that can absolutely take these things further forward, reduce friction, reduce cost, improve performance, and actually having that time to make those sort of decisions is so fundamental to this. As an advisory specialist, I guess, in this sort of space, James, how often do you see that as being something, and how do people navigate that sort of multiple influence and multiple stakeholder issue and the internal friction that you have in organizations to be reluctant to change?
There's certainly no silver bullet, and we do see, quite often when we're having conversations with people who have good transformation ideas, that they do very quickly get diluted by, that's just too hard. Or if I was to move to this technology platform, I've got different groups in my organization that have a different architecture, and the cost of them making that move as well will just completely blow up the benefit case. So it is difficult. I think what it does need is, you normally need somebody with a C prefix at the start of their title. That could be a CAO, it could be a COO, could be a CEO, who really is senior enough in the organization to be able to pull all the different levers of production you need to enable transformation. A head of ops or even a head of technology quite often is not going to do that in isolation. So, that clearly needs to happen to enable a lot of this to move. But for them to take an interest, you've typically got to make it important enough or interesting enough to have that discussion. So I think, is it a material impact to the bottom line? Is it a material impact to perhaps capital usage? Or is it something around perhaps resilience that we're going to see a lot of coming into this year, where organizations last year realized that whilst their post-trade estate kind of may have hung together, it might have been expensive and people heavy, but it kind of worked and we could ignore it. clearly the pandemic really challenged that, moving to a working from home environment. And certainly the volumes and activity that the market saw last year certainly caused, I would say, a lot of C-level people to have to take a lot of interest in these middle and back office processes, where probably they hadn't had to do that previously. So I think there needs to be a reason and there needs to be an incentive. But I think if you can get that top-down sponsorship, and I think if you're able to position that in the right way, that's certainly a way that things can happen. To Alex's point, being able to bring together good data and to give a view of what the future could look like, that's clearly important. But I do also think, certainly I see a change in dynamic around some of the people who are gravitating towards leadership roles. They are younger. They are probably at the stage of their career where they're still going to be there when the transformation's happened. So they don't have the option to say, we'll just maintain the status quo. And I think there is, an increasing reality that these leaders are not going to be able to make easy decisions. In other words, I've got a really nice return on investment. It pays back my cost within 18 months, and it's a really low risk transformation. Those opportunities are not there. What these newer leaders, I would say, are going to need to do is be able to take maybe some kind of instinct-driven decisions. Okay, this looks like the right thing to do. We need to embrace innovation. We might not be able to guarantee the return on that, but actually if we're able to move the organization forward, we're going to need to operate differently to the way than we have in the last 10 years. So from an advisory perspective there, certainly some of the challenges we see, there are some positive spots. We are seeing organizations who are getting senior leaders behind these types of transformations because they recognize that the ability of their organization to join up front to back is actually the biggest obstacle to transformation. It's not tech, it's not cost, it's not regulation, it's actually their kind of own internal obstacles that are probably going to prevent things moving forward. So they're kind of some of the things that I would say are important for organizations as they look forward.
Yeah, I think there's an interesting aspect there of something I've seen in the markets for a long time has been the sort of conservatism that's sort of slowed down innovation, and that conservatism has generally come from, in my opinion, from fear. There's been a lot of pressure that's been put on people to make big decisions that can cost them their careers, and that's sort of driven a fear of change and a sort of slowdown of evolution that we've seen probably happen a lot quicker in areas like e-commerce and retailers, for example, that's lagged the financial markets behind on that. Now, if we look at this last year, and as you say, a few of the events of 2020 that have been the sort of fuel on the bonfire of digital transformation, this allows us this great opportunity to really take this blockchain movement and push it further forward. So if we talked about the past in 2019 and what was happening there, and we've talked about today, let's look to tomorrow. And Alex, give us a little bit of thought around how COVID, the pandemic, everything that we've seen in this digital transformation has allowed us to see what we expect to see in blockchain over the next couple of years.
If you want to link it back to the pandemic, that's interesting, isn't it? So I think that one thing that the pandemic has shown us through the market volatility that we saw and the economic volatility that we saw, certainly in the early part of last year, is the need to have robust, scalable, reliable systems. Yeah. Another is just the value of data, the value of high quality intraday data, which I think, when I talk to people at various of the large banks, I think some of them really struggled to be able to present consistent, meaningful, accurate data up the leadership chain around things like, where are all of my assets posted right now? Where do they need to be? Am I posting in excess or not? Yeah. And that was a real challenge, I think, for some firms, and inconsistent data that was sort of not properly scrubbed, and so on and so forth. That was creating huge misunderstanding within organizations. So that's one thing. I think you think about a couple of other things. The whole working from home thing, the whole sort of headcount, quality of data, that's obviously super important, efficient processes. Here's another one. As we go into a period or we continue through a period of sort of uncertainty where settlement risk in particular and the credit officer's appetite to take settlement risk or to take counterparty risk is going to be really, really challenged. Then again, the ability to, number one, reduce that risk by means of being able to control your payments effectively, but number two, being able to monitor that risk and be able to have absolute certainty of what your risk position is, not only the day after settlement, but during the course of that value date. I think these are really important, initiatives that people are going to have to start looking at, because if I'm a risk officer and I've got, some corporate clients, for the sake of argument, I'm not that comfortable now about having the size of settlement line that I used to have with them. Yeah, I'm probably much more comfortable either doing true PVP or doing some sort of payment on payment process, which needs to be scalable, it needs to be auditable, and so on and so forth. So these, I think, are really important things that come out of that whole sort of COVID environment.
I absolutely agree with you there, Alex. There's so many different aspects of this that point towards an exciting future with it. James, same question to you. Tell us a little bit about what you're seeing as the future here.
Yeah, I mean, again, I think a lot of the challenges that Alex highlighted are very real for people. And I think the scalability and concerns around key person dependency that really kind of came out of the pandemic is going to force organizations to think differently. In stressed market conditions, we've just seen some interesting examples in the US, over kind of the whole kind of Robin Hood kind of scenario that those guys got themselves in. Ability to get kind of good data quickly and enable a risk officer or an organization to make a quick decision is really, really difficult in capital markets. And when you've got more volumes of data and when you've got more steps in your processing chain and more people involved in that process, that can kind of be really hard to pull together. So I do think that's going to be a reference point for organizations as they go into 2021, starting to learn from, what did we see last year? And actually, are there smarter technology solutions out there that actually are not purely interesting to us just on the basis of headcount? Actually, I'm not certain that a lot of organizations necessarily care that much about that. But can you take the person out of the role? Can you automate the process? Can you make the data cleaner? And can you make it easier and quicker, A, to process, and B, to get the data that's telling you what's going on? Because I think certainly the last year has shown organizations that where they're reliant on somebody to put data together, send it on an email to someone else who puts some more data on it, and then that gets sent on to someone else. That's not a great process. It's certainly time consuming. And in a market stress environment, that's where banks lose money. The time taken to get that information can make the difference between taking steps to mitigate a loss or actually end up manifesting itself in losing money. So I'd see that really as a kind of key theme, I think, going forward.
So progress and acceleration seems to be the watchwords of everything we've spoken about today. It's been a fascinating conversation. I'm so pleased that both of you both had the time and shared the time so generously to come on and talk about this. I know it's wetting the whistle as well for a little bit more to come from you, James, with the Financial Markets Insights multi-participant report, easy for me to say, that's going to be coming out soon. So please keep an eyes peeled for that, and we'll help move that around as well, alongside the realization group that I know you're working with that too. And on March the 3rd, there'll be a webinar where you're going into more detail around this as well. Anything you want to add on that, James?
Yeah, no, I mean, I think, as you say, I mean, there's some interesting content there. I think the webinar will be interesting because we've got some of the participants who were in fintechs 2 years ago who are now no longer in those fintechs. So I think they're going to bring a maybe slightly different perspective on some of the challenges and some of the things they've seen. So we think it's going to be a really interesting discussion. So as you say, it's on March the 3rd. Certainly keep an eye out for it.
Thanks very much. We'll put some tags into that as well in the comments when we release this. Alex, James, it is a pleasure as always. Thank you so much for sharing on this. And thank you all for watching. We hope you enjoyed this episode of the debate on FinTech Focus TV. And we shall see you all soon, very, very, very soon. Thank you, Alex, James. Thank you.
Thank you.
Thanks, Toby.